In this video, we are going to learn risk management in a scientific way, once and for all. Welcome back to Trading Manifest. If you choose trading as your career, you should be risk prone as much as you are risk averse, meaning that you gotta love risking as much as you hate it, and vice versa. As a trader, your number one duty is to keep your risk management in place. So in this video, we will take a step-by-step approach to build a risk management system. First, let's see what we're going to cover throughout this video. In the beginning, we will review the common misconceptions about risk management in the financial markets. Next, I'll show you what key risk management parameters are and how to set your trading plan based on them. And in the end, we will build a risk management model together as an example by programming a simple trading bot and testing it out on the real market to see our trading results. Okay, let's get started. Misconception number 1. There are only two factors to build your risk management with. One is reward to risk ratio and the other one is your win rate. While both of them are crucial factors, there are other factors that we need to consider to build a suitable risk management system. If you just want a paper trade, then yeah, win rate and R to R ratio should be the only things that matter to you. But when you decide to trade with real money, you have to have a rough estimation of your returns in comparison to other financial activities, such as buying treasury bonds or investing in stocks. The second misconception is that many educators tell you that less than 1 reward to risk ratio is not profitable. And at least you need to have a ratio of 2. In theory, you can be profitable with any ratio. It just depends on many elements such as your characteristics, trading strategy, and your account size. It's also good to know many scalping strategies, especially the ones that are automated by trading bots, have a reward to risk ratio of less than 1. So these were the misleading mentorships that I see a lot on social media. Now let's try to develop our own risk management system and rectify these misconceptions along the way. You might have heard that the financial market is the market of probabilities. Hence, we can describe its behavior by merging the market characteristics and mathematical probability concepts. Assume that we have a total random trading strategy with a 1 to 9 reward to risk ratio, and we want to trade a total random market with it. What do you think our win rate would be in this scenario? The probability theory tells us that our win rate will be 90%. Now that's amazing, isn't it? No, it is not. Because in a perfect world, we will end up break even, and in the real world, we will have a negative P&L because of the broker spread and commission. Now this time, suppose that our hypothetical trading system has a 1 to 1 R to R ratio. What would be the win rate? Yes, exactly, it would be 50%. But again, like the previous story, we will be break even. So how can we fix this? We want to be profitable, not to be in the mud. Well, there are a few things we can do to swing the odds in our favor. One is learning technical analysis such as supply and demand zones or trend lines. The other one is to boost your fundamental knowledge about the market or the asset you want to trade. So let's say we did all of that and now we have a trading system with an R to R ratio of 1 and a win rate of 55%. How much we can make in 1 year? Well, I must say we still don't have enough information to answer that. We need to introduce 3 more parameters to find this out. The first parameter is the risk percentage for each trade. And the second one is the frequency of our trading system. meaning that the number of trades that can be taken during a certain period of time with a trading system. The last one is the maximum daily drawdown, which is the maximum allowed difference between the start of the day account balance and the account equity. It might have been set by you or someone else, such as an investor. With the help of these 5 parameters, we can develop a proper risk management system. Let's jump into Microsoft Excel. I'd like to show you an example. So here we have 5 trading systems and system 1 as our reference system. It has a reward to risk ratio of 1, win rate of 55%, risk per trade of only 0.5%, and it gives us 100 trades per year. Thus, it will be making 5% in 1 year. System number 2 is quite similar to system number 1. The only difference is that it gives us 150 trades per year and the annual return is 7.5%. System 3 has a higher risk per trade compared to the reference system, and the other parameters are exactly the same. Thus, the return will be 8% for it in 1 year. System 4 has only a higher win rate compared to the reference system, and we can see the return is exactly the same as system 3 with 8% per year. And our final system, system 5, has a slightly higher reward to risk ratio with 1.1 reward to risk ratio, and we can see the return is 7.75%. I assume that my number of signals per day is low enough to not reach the maximum daily drawdown level. But you can calculate it as well if it happens for your trading strategy. Now you know why I've been insisting on factoring in other parameters in addition to R2R ratio and win rate. Because you can clearly see the differences when we change the other parameters other than win rate and reward to risk ratio. So we can see the returns here are very different from each other. Therefore, you should always have a rough estimation about these 4 parameters when making trading systems. Based on what we learned so far, let's create a trading strategy and apply our risk management system to it. For this part, I have just created a robot to trade for me. This bot trades based on the deviation from the moving average. If the deviation occurs above the moving average, it buys the asset. And if the deviation occurs below the moving average, it just simply sells the target asset with a risk percentage that we choose. So let's take a look at our MetaTrader platform. I set the simulation period to October 2024 and the initial deposit to $10,000. I will then head over to the Inputs tab. There are a bunch of parameters here that we can set, but for this video the only ones that matter to us are risk, which I set it to 0.5%, stop loss coefficient, which is 9 here, and the take profit coefficient that I set it to 5. The take profit to stop loss ratio is our reward to risk ratio here, which in this case is 5/9 or 0.55. I leave the other parameters as they are and start the simulation. Alright, now that the simulation is complete, let's head over to the backtest tab to review the statistics. So the bot made a total of 32 trades, which 26 of them were successful trades here. And 6 of them were losing trades. And it made $417 of profit. Although this is just a demo bot and we cannot fully rely on a month of profitability, this example shows that you can have a trading strategy with less than 1 reward to risk ratio and still make money. We are not done here, guys. There are a couple of parameters left to examine in this report. When backtesting, we should pay attention to our maximum equity drawdown and consecutive losses to make sure we do not hit our maximum permitted drawdown. I mean this parameter and this one right here. It's good to know that the higher our reward to risk ratio is, the more consecutive losses we get. Let's run the simulation one more time and changing the stop loss coefficient from 9 to 3. In this simulation, the reward to risk ratio is 1.66, which is greater than our previous ratio of 0.55. I hit start. Then I go to the backtest tab again. As we expected, the number of consecutive losses in this simulation has increased to 3 now. Therefore, you have to be very cautious when you're choosing a high R2R ratio for your trading strategy. I also have a pro tip for you as well. Please do not get confident on 1 month of profitability and backtest your strategy at least for 2 years to see all the cycles of the market, such as a bull run, bear run, and a ranged market. In addition, when you master your backtest for an asset, start taking forward tests. And this time choose your reward to risk ratio and risk percentage, not constant, but floating numbers based on various market conditions. I hope I could simplify the risk management for you. If you have any questions regarding the topic, please let me know in the comments. Thanks for your attention, and I'll see you next time.